I'm going to talk a little bit about what's going on in corn and soybean markets, and then focus in a little bit on some risk management strategies that I think are going to be important to implement as we move through this summer. And so when we look at kind of what's been going on in corn and soybeans, I don't want to spend a lot of time on supply and demand, but I do want to provide a quick update as to what's going on, just because we have seen the new crop estimates were released in May by the USDA. There'll be another update this Friday to the June WASDE, but we do have a kind of a shifting picture in terms of supply and demand. And then I want to talk a little bit about what's going on with old crop, new crop prices. We are still seeing those spreads. But they have both kind of softened a fair amount. But we are seeing those spreads continue just because of some of the supply and demand issues that we've seen in the U.S. And then I want to talk about where we're at from crop insurance and what we're looking at in terms of a risk management strategy based on current price levels as we move into the rest of the production year and into the harvest and post-harvest interval. The last thing I'm going to talk about, I did a little Southern Ag Today article for those of you that want to go read the whole thing, talking about the effect of interest rates when we're looking at the cost of holding corn in storage. I'm still a huge proponent of storing our crops in Tennessee. I think our seasonal price appreciation, both through the futures market and particularly on the basis side of things, is a very sound strategy. I do think that we have to be more cognizant of how we manage the price risk in the futures market, and identify those basis opportunities that are there. But when we're looking at that, we do have to recognize that because of higher interest rates, particularly those that have an operating facility, the increased cost of holding that grain is substantial when we've seen these increased interest rates. So just to kind of jump into the supply and demand situation, this is the corn production, consumption, and ending stocks. There's just a couple of things I want to end up pointing out. We're looking, or USDA is forecasting a rebound in corn production. A lot of that is driven by a rebound in the U.S., which we'll talk a little bit about, but also with the second crop of corn down in Brazil. One of the key numbers that I do want to highlight is that increase for the 2023-2024 marketing year for ending stocks, where we look at that rising to 12.32. So what we're looking at is an increase in the available global supplies. When we look at the U.S. picture, and again, right now, I would say that weather is going to be the most important factor as we move through this summer. But as you can see, we're looking at a rebound in U.S. production up to 15.26 billion bushels. Obviously, there's a lot to go on. We just kind of are wrapping up the planting season across most of the country. One of the key numbers that I'm going to be very interested to see how it plays out is going to be the export sales numbers. I think that's going to be real critical in terms of maintaining some price strength. But again, the takeaway on the corn side is, yes, we're looking at potentially building stocks if we do get weather cooperating, and with some of the longer range forecasts with the El Nino coming in, there is a reasonable chance that we are going to have beneficial growing conditions for parts of the Midwest and the Southeast. There's still a lot of uncertainty there, but again, when you look at some of those forecasts, it does look like it is going to have higher production than last year, and that would be obviously negative for prices. When we flip to soybeans is where things get a little bit more concerning, particularly on the world side of the equation. That big increase in production, where you see we're up over 15 billion bushels and carryover at a record high of 4.5. That is a pretty direct result of the record Brazilian production that we've ended up seeing. When we look at what happened down in Argentina with their drought, Brazil more than made up for any losses that were in Argentina with that record crop that they had. So there's going to be some pressure continued on soybean exports from the U.S. I was actually reading an article this morning, and the U.S. might actually import record amounts of soybeans from Brazil. And that's because of how weak the basis is down in Brazil. And so they're bringing them up to end up crushing them for the summer months until we get our fall supplies, because we do have reasonably tight stocks in the U.S. for old crop soybeans. And so when we look at where we're at, that 220 million bushel estimated ending stocks is pretty tight in terms of where stocks are. And that's why we've seen some imports coming in from South America to help alleviate some of the reduced supplies that we've ended up seeing. But again, when we look at USDA's new crop projections, we do end up seeing a rebound in terms of production, and then we're going to be highly competitive with Brazil moving forward. So again, this is something where there are some potential challenges on soybeans if we continue to see Brazil stack these record crops. So just to kind of summarize the supply and demand, I already talked about South America. There's still going to be continued global influences, particularly when you look at Russia, Ukraine, and how those commodities are going to be able to access international markets. There's a lot of uncertainty embedded there. It seems like there's kind of a risk premium built into the markets because of that uncertainty. We are also looking at kind of some of the macroeconomic conditions. How do we end up dealing with inflation? What do we end up seeing in terms of the potential for a recession, and how long that might persist if we do end up getting one. We are looking at a point where we're looking at stock expansion for both corn and soybeans, and that would anticipate weaker prices moving forward. Planting is pretty much complete for a lot of the major producing regions, and weather's really going to dictate where we are. And I did throw up the recent drought monitor map just to kind of show that we have seen some dryness creep into the Corn Belt. The long-term weather forecasts are still mostly beneficial, and we do have some pretty good rain that's going to cut across that Missouri and Iowa area in the next 7 days. At least that's what the weather forecasts are indicating. So again, we're going to see futures prices very sensitive to what happens in terms of precipitation across those regions. When we look at prices, this is the nearby corn futures price and the basis for Northwest Tennessee. So I just picked one area to look at. And what I wanted to end up getting at with this is for the old crop, what we ended up seeing is, yes, we've seen futures prices soften a fair amount. From up where we're close to, that 6.80 range down to where now we're closer to that $6 range. But we have seen that basis widen and expand. So the net cash price hasn't decreased as much as what the futures have. So again, when we're looking at kind of our strategies, we always want to consider and disaggregate that futures price from the basis to make sure that we're getting the both out of those pricing mechanisms when we're talking about risk management. When we're looking at kind of what we've seen in the past in terms of volatility and average prices for the December contract, you can see right now we've averaged 570 this year on the December contract. We're a little bit below that right now. And the green diamonds on this chart is actually the projected crop insurance price. And that's an important consideration when we look at our risk management plan. Where are we in terms of potentially being having prices that are going to end up triggering payments? We'll talk a little bit about that a little bit later on. When we look at that new crop price, pretty much we were very fortunate that when we established the crop insurance price, we stayed pretty consistently around that 590 area. Since then, we've pretty much dropped down, and then we've seen a rebound recently off those lows where now we're back up to that kind of 540 range. Weather's going to dictate whether we stay there or if we end up dropping back down below. Right now, I would say there's more downside concern in the market in terms of new crop prices if weather cooperates. If it stays dry or intensifies, then obviously we would expect to see prices continue to end up going up. When we look at soybean nearby futures, again, this has been a big component of the Brazilian market hitting global trade. We've seen prices come down very dramatically from up where we were at that 15.50 range all the way down to below $13. So again, we've seen those soften, and based on where the supplies are in the exports coming out of South America, we're anticipating that that's probably going to end up keeping some price pressure below that $14 mark on the nearby soybean futures. Basis has kind of been a bit of a mess over the last 6 months. It's bounced around a fair amount. We've all documented issues with river flow, both too little and then too much. So that's influenced the movement out there. But again, what we've ended up seeing is we do see that seasonal basis coming up, but that's going to be affected by what goes on along the shipping corridors there. When we look at the same picture for corn. Again, we're slightly below where that crop insurance guarantee is, but we are still seeing that volatility. And when we look at those blue bars along the bottom, that's the max minus the min. And so it gives us an idea of what the trading range is for the November soybean futures contract. Right now, we've had a 270 range. It would not surprise me at all if we got close to $4 by the time we were done with this upcoming marketing year. So that volatility, I don't think is going to go away. And unfortunately, I see a little bit more downside risk in this market than the upside on soybeans right now. When we look at new crop prices here, what we've seen is that dramatic drop, but hopefully we're starting to move sideways around that $12 range. So hopefully we'll end up seeing prices find a new trading range and stop this downtrend. But again, I do think that protecting against that downside risk is what we need to end up considering. So just to kind of put it together in terms of a risk management and marketing strategy, I'm a big proponent of evaluating where you are in terms of your crop insurance, whether you're doing just the multi-peril crop insurance with a buy-up percentage between 50 and 85%, or if you have companion policies, you can look at what your risk exposure is there. And then again, looking at what's that in-season price risk management strategy that you can maybe take some of that price risk off the table without fixing a price if you don't feel that you're getting the prices that you would like. And then again, I'm always a huge proponent of storage for our producers. I think that's one of the stronger consistent returns that we will end up getting as we look at being able to access the market post-harvest. I did want to just throw in just the crop insurance price triggers. And so just to kind of explain what's going on this slide is right now we have a largely unknown yield. So we're keeping yield consistent with the APH for the insured unit. And then you will have farmers that will have buy up between 50 and 85% plus any companion policies. Just for a reference point, the average buy up for corn in Tennessee was 72.8%. So again, we have a lot of producers that are in that 70 to 75%. Some are a little bit higher on that. And what I ended up looking at was, okay, well, what's the price trigger? So if we hold yield constant relative to our APH, what would prices have to get before we're looking at getting a crop insurance indemnity payment? And so at an 85% buy-up, we'd have to get to 502. At a 75%, 443. So again, we're still a long ways away from that. So we do want to end up considering what's another method to end up protecting prices, particularly on the future side, when we have prices higher than where we are in terms of our crop insurance. Same thing for soybeans here. We had a 1376 crop insurance price. And even at 80%, you're at 1101. So again, the market is higher than where we are in terms of prices. Now, again, the crop insurance is a tremendously important risk management tool because we both have the price and the yield component. It's just that we don't know what the yields are going to look like for the upcoming production season. So one of the things that I think is important, I'll use this as an example, and you can switch between the different contract months depending on if you're planning on storing or how long you're going to end up storing. But I kind of wanted to break this down just from a profitability standpoint, which I'll show in the next slide. But I think it's really important to take those cash prices that are being offered and disaggregate them between what's the futures price and what's the basis component. And so one of the strategies that I was looking at is if you buy a 560 May 2024 put option for 49 cents, that sets the 511 futures floor. What that does is it removes 92% of the futures price risk, which I think is more substantial than basis risk, and 84% of the total projected price risk. So when we do that, we're setting that floor. Yes, it costs you a premium, but it leaves that upside open in the futures market, and it leaves the flexibility to set basis at a later date. You could set basis now too. If you get a beneficial basis offering, you can set the basis price. If you say if you have a target of a dollar, right, it's going to vary across the state. Basis is very different depending on which part of the state we're in. But if you do get a beneficial basis offering, you can end up setting that. But what I'm more concerned about, because our basis is usually pretty consistent as we end up moving through the year, it tends to increase pretty substantially as you get further away from harvest. I think I've shown the slides on the returns to storage several times where we get about 80, I think it's 84 cents if we can store that corn until March, and about $1.20 for soybeans. So again, I think using strategies like this really ends up taking some of the risk out of the futures market, which we have no control over. The other one that I always say with these options premiums is I'm not a big proponent of carrying them until expiration. I think it's important to exit that option position, recoup some of the premium, and establish a price using another pricing mechanisms. But the key takeaway on this is I think that it's really important to look at how can we mitigate some of that price risk in the futures while allowing us to end up considering our basis opportunities at different intervals during the year. When we look at projected net returns, we did a quick update using just basically straight average Tennessee yields when we're looking across cotton, soybeans, and corn. And the reason why I wanted to show this is, yes, we've seen some of those input prices come down pretty substantially, particularly fertilizer. And the main takeaway here is if you look at those break-even prices at the bottom, I still think there is some profit on the bone, even with the prices that we've seen decrease. I think it's important to understand where are we at in terms of a profitability standpoint. I know we talk about prices all the time, but we don't farm for prices, we farm for profits. And so when we look at where we're at right now, can we protect these prices at profitable levels so that we can end up locking in or at least have a good opportunity to lock in a profitable year for 2023? Because as mentioned, if we see prices continue to soften, this is going to continue to end up impacting where we're at. Obviously, with it being this early in the production year, we can also see, the potential for increases and decreases in what our yield expectation is. But I think penciling out just what we've got invested in the crop, what some of our fixed costs are, and seeing where we are, I think is really important to end up looking at. I want to close with this, and I don't know if Andrew's going to talk about this, but I will give a plug for his recent publication. He did a great job on the livestock side of things, looking at the effect of interest rates. But I did want to talk about this because it is a different interest rate environment right now, and that does affect what our costs are in terms of storage. So what I looked at corn held in storage. The interest rates, or the bank prime rate, is shown on here. And what it does is it estimates what your daily interest rate is, and it's a combination of what the value of the corn held in storage is and the interest expense that would be on an operating line of credit. And what you can see is the daily interest calculation in black, and then the accumulated interest from the end of September all the way into May, which is 30 cents per bushel. So again, when we're at 8% interest, it's a very different carrying cost when we have an operating loan and crop held in storage versus if we're down around that 3.5%. Now, when we look at interest rates, I think we probably will end up peaking, sometime in the next quarter. I think they might do one more increase, and then after that, we'll have to see what happens in the fall. But I think that there'll be at least some pressure, maybe by the end of 2023 or early 2024, to potentially lower the interest rates a little bit. But again, a lot of that is going to be dictated by what happens in the labor markets and how inflation is handled moving in over the next couple of months. When we look at this, I think this is another one that's important. This incorporates that interest rate in there. And it's a combination of when or what the net price would be based on both increases in basis and the interest of carrying it. So that blue line is the 661 average selling price when you are subtracting the cost of holding that corn in storage. And you can see anything above that line was an opportunity to end up exceeding those returns. What we've seen that fall pretty dramatically, because obviously when we look at where we're at as of the end of or the start of May, that full 30-cent carrying cost is embedded in there. So what we're looking at here is the net. We're taking the futures price, the basis, and then subtracting the interest costs and seeing where we are in terms of that net cash in your pocket after you've paid off the interest accumulated in your operating loan. But again, this is important considerations for producers, not just for the crop that is right now, but as we move into the fall, because I don't think we're going to see a tremendous softening in interest rates through our primary grain marketing year for the 2023-2024 marketing year. So again, we'll have to factor in these increased interest costs for crop held in storage. With that, I think we have seen I guess I don't want to say a subsiding of some of the global economic uncertainty, but I think there's been a risk premium kind of factored into markets. I think we're going to continue to see the volatility out there. I do still think that short of a weather event, there is still a bias for further weakness in corn and soybean markets. I think it's important to kind of look and see what the price risk management and marketing strategies you can take some of that price risk off the table and hopefully lock in some profitable opportunities, and continually evaluating what your crop insurance, your price risk management in season, and what your storage availability is, I think is going to be key to successful 2023.